There was never a global vote, no public announcement, no emergency meeting broadcast live, no declaration that would make headlines. And yet, one of the most important power shifts in human history quietly took place, changing who really controls economies, governments, and even the future of entire nations. Because there was a time when money represented value that already existed, and then it became a promise to repay something that didn't. Today, almost every unit of currency in circulation, whether it's dollars, those pounds, or rupees, enters the economy in the exact same way as debt. Not as wealth created, but as wealth owed, which raises a deeply uncomfortable question. If money is created as debt, then does our economic system require someone, somewhere, to always remain in debt just to function? To understand how we got here and why this was an accident, we need to go back to when money was something very different. Setting the stage, when money meant ownership for most of human history, money wasn't created by lending. It was discovered, mined, forged, or harvested through labor. Gold had to be dug out of the earth. Silver had to be refined. Grain had to be grown. Money represented stored human effort, something real that already existed in the world. When kingdoms or early states issued coins, those coins were typically backed by a physical reserve of precious metals. A gold coin wasn't a promise, it was the payment itself. But physical money had limitations. It was heavy, hard to transport, difficult to divide in large transactions. So eventually people began depositing gold with trusted institutions, early banks, in exchange for paper receipts. Those receipts could be exchanged for the gold at any time. And that's when everything changed. Because banks realized something very important. Not everyone came back for their gold at the same time. Origins, the birth of money from lending, once banks noticed that depositors rarely withdrew all their gold simultaneously. They began issuing more paper receipts than the gold they actually held. They would lend out claims to gold that didn't exist, knowing that statistically, most people wouldn't redeem them all at once. This was the quiet birth of fractional reserve banking. New money could now be created simply by issuing loans. Instead of representing value already produced, money now represented a promise to repay value in the future. This meant something profound. Every new loan created new money, but it also created new debt. And crucially, the debt always exceeded the money supply because loans came with interest. So if a bank created $100 through lending, it might expect $105 back. But only $100 existed, meaning someone, somewhere, would have to borrow again just to cover the difference. The system could no longer stabilize. It had to expand. Risk debt becomes the engine as governments partnered with banking systems to finance wars, infrastructure, and national growth. This debt-based model became institutionalized. Instead of taxing citizens directly to fund large expenditures, states began borrowing newly created money from banks. Government bonds became the backbone of national finance. Money entered circulation not through production, but through public debt, and this changed incentives. Economic growth was no longer tied only to productivity or innovation. It became tied to borrowing capacity. Recessions weren't solved by producing more goods, but by injecting more credit. When economies slowed, central banks lowered interest rates to encourage more borrowing. When that wasn't enough, they created reserves digitally to purchase financial assets, a process now known as quantitative easing. The deeper the debt, the more money existed. And the more money existed, the more dependent the system became on maintaining that debt. Breaking point when repayment became impossible by the mid-20th century. Global economies were operating on a hybrid system, part commodity-backed, part credit-driven. But in 1971, the last direct link between the US dollar and gold was severed. From that moment forward, money was no longer redeemable for any physical asset. It became entirely fiat, sustained by trust, taxation, authority, and legal tender laws. But more importantly, it became entirely debt-based. Since then, global debt levels have grown faster than global GDP every single decade. In 1970, total global debt hovered around $10 trillion. Today, it exceeds $300 trillion. That's more than 3 times the entire annual economic output of the planet. And yet repaying it all would collapse the system, because paying off debt destroys money. So the solution has always been to create more. Out the new power structure. This shift didn't just change finance, it changed power. Control over money creation meant control over interest rates, credit availability, government spending, asset prices, inflation levels, employment cycles. Those who could expand or contract the supply of money could indirectly influence nearly every aspect of economic life. Housing booms, stock market crashes, currency devaluations, sovereign defaults all became tied not just to market forces but to credit conditions. In this world, financial crises weren't just random failures. They were moments when debt expansion slowed, and the system had to reset. Failed fixes printing our way out time and again. Policymakers have tried to solve debt-driven slowdowns by adding liquidity, lowering rates, buying bonds, bailing out institutions, stimulating demand. But each intervention increases the system's reliance on debt expansion, and each cycle requires more borrowing than the last to generate the same growth. It's a treadmill that accelerates over time, because once money is debt, you can't reduce debt without reducing money. Modern parallels, the pattern repeats after the 2008 financial crisis. Central banks created trillions in new reserves to stabilize global markets. In 2020, during the pandemic, that number doubled again in record time. Public and private debt surged, asset prices followed, but wages didn't keep pace. Inequality widened, and now many governments face interest payments that rival their largest social programs. The pattern is clear. When debt expands, liquidity flows upward. When debt contracts, economies slow. So the pressure to borrow never disappears. It compounds. 3 takeaways in modern economies. Most money is created through lending, meaning debt is not a byproduct of the system, it is the system. Repaying large-scale debt reduces the money supply, making full repayment economically destabilizing. Control over credit creation translates into indirect control over economic outcomes. Final thought, we often think of money as a neutral tool. But what if the way it's created quietly determines who holds real power? What happens in a system that cannot function without expanding obligation? Call to action if this changed the way you think about money, credit, or economic stability. Consider subscribing for more deep dives into the systems that shape our financial reality, often without us ever noticing.